Welcome to Capital Link's company presentation series.
Welcome to Capital Link's corporate presentation webinar series. In this series, senior management of listed shipping companies provide an update on their operations, business development, strategy, and sector outlook. I'm Nicholas Bornois, president of Capital Link. Capital Link is an investor relations firm also active in event and conference organization. We work with several private and publicly listed companies, including companies featured in this webinar series. As noted in our disclaimer, these presentations are purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and Capital Link bears no responsibility for them. Today, we have with us the senior management of Safe Bulkers. We have with us Mr. Loukas, Barmparis, President and Director, Mr. Konstantinos Adamopoulos, CFO and Director, and Mr. Thanasis Antonakis, Assistant CFO and Chief Compliance Officer. The whole session will be 45 minutes. We will start with a brief slide presentation followed by a live Q&A session. Please submit your questions through the Q&A button at the bottom of your screen. Please include your name and company affiliation. Alternatively, you can email your questions to us at webinars@capitallink.com. Thank you for joining us. And now I'm turning the floor over to Mr. Loukas Barmparis, President and Director of Safe Bulkers. Loukas, go ahead, please.
Good morning. Good morning to all. First of all, we want to wish you a happy new year, a safe new year without the disruptions that we had in the past in relation to COVID-19. Here you see our forward-looking statements in slide 2, and we move downwards to the next slide. Okay, here we are. We present certain information in this slide, certain historic important information. So Safe Bulkers, we have a track record, as you all know, of more than 60 years. The interests of the management are fully aligned with the interests of the public shareholders, since our CEO, Polys Hadjiouannou, owns 40% of the issued and outstanding capital. A key point is that our contracted revenues for the following years is 430 million. Because we operate in a number of vessels, scrubbers, we have an additional capability to produce a revenue of about 15 million due to the scrubbers. The company has total assets of about 1.1 million. Its debt is 401.9 million, and is comparable to the scrap value of our ships, which is 378 million. We have 39 dry bulk vessels on the water. 80% of these vessels are Japanese built, meaning superior specification and better energy efficiency overall. We have ordered 9 Japanese new builds with the latest available technologies, which is IMO greenhouse gas EEDI phase 3. This is a design index that requires the reduction of the CO2 emissions by 30% compared to the year 2008. And this regulation comes into force after 2025. Presently, we have a phase 2, which requires only 20% reduction. And of course, tier 3, which means that reduced emissions of NOx. We have already paid 44.9 million of in relation to new build capex as of Q3 2021. One of the key points that we have raised during the last year was our deleveraging strategy. The leverage presently of the company is about, at the end of the quarter, of the third quarter, is about 34%. We have made a huge improvement there, and right now, as we see just above, our debt is comparable to our scrap value, and we are at a stage where we think we are very close to the optimum level, and I think that towards the end of last year, we will see this leverage ratio improving a little bit. We maintain always substantial liquidity. We have cash on hand as of the quarter end of 92.2 million, and we have also borrowing capacity of 164 million. This is good because we can use this capacity, which is normally which comes either from a drawn borrowing facilities or RCFs, and this can be used easily and quickly if we want to pursue an opportunity. So this is also a key point of our strategies, to maintain low leverage and the substantial liquidity so we can pursue opportunities. We have taken a decision to compete on the basis of environmentally advanced fleet, which we are renewing, and we're making additional orders, and the overall and the final target is to create value for our shareholders. Let's go to the next slide. Here we present some points of our history, starting in 1958 with the first investment. 2013, 11 eco ships were ordered by us. 2019, 2020, we made investments in ballast water treatment and specifically on scrubber equipment for reduction of SOx, which pays back. In 2021, we made investments in the latest technologies available, latest designs available in Japanese shipyards of IMO Phase 3, NOx Tier 3. And during 2021, we made some additional renewal, selling older or less efficient ships with and substituting with younger Japanese ships. All the targets are, all our efforts are to compete on the basis of environmental performance. Let's go to the next slide. Here you see the development of our fleet over the years. From 2008 at 11 ships. Right now we're at 39 ships. We have reduced a little bit this because we have also added these new build orders, which will start coming from next year. These 9 new builds have been ordered the last year, and at prices which are low 30s, and they have deliveries from the second quarter of 2022 until the first quarter of 2024. Let's go to the next slide. Here you see our diversification in relation to scrap, to sizes. We have 5 Capesize vessels, 15 Post-Panamax, and we expect to add 3 more, 7 Kamsarmax, and we expect to add 6 more, and 12 Panamax. 80% of the fleet, as we said, is Japanese built. 17 ships are scrubber fitted. The average age of our fleet right now is 10.4 years, and in January 2024, it will be at 10.4 years, basically because of the renewal of our fleet and the new deliveries that will gradually come to us. Let's go to the next slide. Here you may see our performance, net revenues, EBITDA, and adjusted EBITDA. The last column represents the 9 months. You see that the performance of the last year was substantial and was very good for our company, and we managed to create substantial revenues and profits. Let's go to the next cycle, to the next page. Thank you. Here are some of our major investments. We prefer to cooperate with major clients that you can see with end users, and we have established consistent cooperation with them, which gives us an advantage either in good or bad times. In the next slide, you see certain selected financial information. The contracted revenue of 430 million as of September 30 represents a quite important amount for the company. Our net revenues for the Q3 were 92.5. Our net revenues for the 9 months, 236 million. The EBITDA 72.4 million for the third quarter, and 161.9 million for 9 months of 2021. The leverage, which is very important, under part 3, we used to have 60. I mean, these are approximations, of course, based on the vessel valuations, but the overall leverage was about 60% on December 31st, 2019. It was 66% on December 31st, 2020, and it is right. It was 34% on September 30, 2021, and we expect that this figure will continue to, it will become lower towards the end of the year, of the previous year, reaching the required and the optimum percentage that we think is suitable for our company. If we go to the next slide, we see certain information about the markets. You know, we all know that substantial stimulus in infrastructure spending has been introduced globally in USA, in China, in EU. The China GDP, which came recently out, was 8.1% up. You know all that we rely on the transportation commodities to China. We bring there substantial quantities of dry bulk, such as coal and iron ore and grain. The expected increase of on demand is about 4.5%, exceeding the supply of the vessels. On the right-hand side, we see a graph for a CRB commodity index, which shows that this vessel has this index is increasing, while BDI has a small correction towards the end of the year, basically, and during January, because this is a seasonal effect, and also it is related with the Chinese New Year. If we move to the next slide, we see certain information about the age and the order book of our fleet. As we have discussed, we operate in the Panamax to Post-Panamax range. We have most of our vessels are between 76 and 95,000 tons, and we also have 5 Capes. And the average age of 47% of the Panamax fleet is above 10 years old. And as you may see lower in the graph, the ordering that it used to be substantial in the past, right now is very low, and basically there are no deliveries after 2024. One important factor here that we need to notice is the change of regulations, and we will discuss a little bit more later. It's a change of regulations which will be introduced from 1st of January 2023 in relation mainly to greenhouse gas emission regulations, CO2, etc. If we go to the next slide, we show, I think, a very important table in the environment that we will compete in the next, in a year from now, in January 2023. Most of the fleet presently does not belong to a IMO index phase. I would like to remind you that IMO decided a number of reductions with a base year of 2008. The 0%, the 1% represents 10% reduction. The 20% reduction is for phase 2 between 2020 and 2024. And our new builds are in phase 3, which comes after 2025. So basically, a large number of vessels, about 80%, 9,619, do not correspond to any of these EEDI indices. EEDI means Energy Efficiency Design Index, and it's a design index related to the performance, to the environmental performance of the vessel. And obviously, they need to do something. They need to do some additional things to achieve after the 1st of January 2022, because all such EEDI vessels need to reduce their EEDI index by 20%, and that mainly can be achieved either by some investments, energy efficiency investments, or alternatively by the reduction of the speed of the vessel, meaning slow steaming. So basically, we believe that this will be a completely different environment after a year from now. Further to that, I would like to just point out that additional legislation like carbon taxation schemes are introduced in Europe, which will also put additional burdens to the global fleet for the performance and the compliance with the CO2 emissions. And also we have another important index, which is the carbon intensity index. Basically, it is called the CII. And I think this will play a further and more important role than EEXI, because this will measure the exact emissions, will relate the exact emissions of each vessel to the transportation capacity, and which will be shown as ton miles. And with this index, all vessels will be classified in energy categories A, B, C, D, E. Vessels which drop to category E will need to do some investments within a year, or vessels that are in the category D will need to do some investments in the next 3 years from the day that they are entering. All these represent a restriction on the ability to operate vessels, and our company is considering has considered all these new regulations in order to create this policy that we're implementing, the new buildings and the renewal of the fleet, plus a number of investments in the existing fleet that will upgrade their environmental performance. If we go to the next slide, and the next, you all know that we have issued the environmental and social governance the last, I think, September. And there we have included all our actions in relation to code of ethics, whistleblowing policies, disclosure policies, what we do with the environment, and all our targets, and how we can deal with the sustainability in the future. So if we go to the next page here, you see that we have done 67.2 million of investments. in our ecology program. 17 vessels have been fitted with sulfur oxides, and this represents not only profits for us, but also substantial reduction, and we'll see in the next page, we have substantial reduction of SOx emissions. And basically 35 of our vessels have already ballast water treatment systems, and all our new ships are coming with a regulation EEDI phase 3, which means that will be the best in the market, and there are no other ships like them producing lower CO2 emissions. Our company is also certified with ISO 50001 for energy management and ISO 14000 for environmental management. If we go to the next slide, we see here that we made some achievements in relation to air, which is grams of CO2 per ton mile by 3.7%. The transporting work has been increased, and also the important thing is that if you see in the lower part of this graph, our SOx emissions have been reduced by about 75%, mainly because we operate our scrubbers not at 0.5% sulfur content, but below 0.1% sulfur content. So if we move to the next slide, once more, we present a number of actions as a summary. What we have done. Safe Bulkers is one of the top 10 pure dry bulk vessels. We are focused on the dry bulk. 40% is owned by our CEO. We have strong balance sheet. We have ample liquidity. We have low leverage. We have secured cash flows, consistency in strategy, risk management. We have 9 new builds in Japan. 17 vessels are scrubber fitted. That gives us additional revenue, and we expect a good year for 2022 because we believe that the supply of the vessels, which is quite low, will not exceed the demand for transportation of dry bulk commodities, and thus the market will continue to be very good during the next year, despite, of course, the seasonal variations that always are observed. If we now go to the next slide, and here we have a number of we have appended a number of data for our fleet and some financial information. So I'm happy that I'm concluding right now this presentation. I would like to thank you all and to wish you a happy new year again with safety and health. And we are ready here, our management team, to take any questions that you may want to ask. And of course, we will try to respond to such questions. Thank you again.
Just to remind everybody that they can submit questions through the Q&A button at the bottom of the screen, or email the questions to us at webinars@capitallink.com. And I think you already have a number of questions. So Loukas, Konstantinos, and Thanasis, please go ahead.
Yes, so I will ask the first question that I've seen here is, how do you believe the environmental regulations that will come in force starting in 2023 and further down the road in 2025 will affect the dry bulk? So I will respond as follows. The regulations changed a lot after the 1st of January 2023. there are several regulations. The one is called EEXI, which adapts the old vessels design index to and reduces by 20% its their environmental, their CO2 emissions. And the second, which is, I believe it's more important, is the CII, Carbon Intensity Index, that will measure the exact performance of its vessel. If we think that all such reduction will have as a result the reduction of several ships that presently are they operate not efficiently, and this, I think, will be an additional reduction of the ship capacity after 2023. Further to that, if we consider the environmental taxations in Europe, and maybe other countries will continue, in the United States, in Canada, in Japan, I think this also will represent an additional burden for the transportation. So vessels that have that belong to phase 3, or they have done environmental investments, will be able to compete substantially better compared to the majority of the fleet, which is about 80%. A second question: have you considered alternative fuels for your vessels? My response is that we are monitoring the market. We know that there are efforts for additional to produce alternative fuels with zero footprint. We don't believe that presently there is a solution, a clear solution. There are discussions about methanol, about hydrogen, about ammonia, but I think that this will take at least 10 years from now for a global implementation, probably after 2030, because first of all, you need to decide the fuel, to design the vessels, and then also to create a global network. And such fuel must be green. For example, we all know right now that there is production of hydrogen, but it's not green, it's gray, because it's produced from fossil fuel. So that this does not improve the situation. I think that what we did by ordering these phase 3 vessels is very important, because basically we have secured the best ships for the next 10 years. Another question that I see here says, why did Leasebacks decide to invest and place orders in new build vessels when the future has not been decided? I think I answered this question. I think that because for the foreseeable fuel, this is for the foreseeable future, this is what we could do and what we could achieve. And so basically, there is no other pragmatic solution but phase 3 vessels presently. And you need to decide whether you stay with the old fleet, or whether you decide to stay with new builds that will be able to compete with the majority of the fleet for the next decade. There is another question here, as I can see, regarding the capital allocation strategy, fleet expansion, debt reduction, share buyback, and dividends. I think that it's clear that the last year we deleveraged the company close to the optimum level that we consider. And we also made the necessary renewal of the fleet and the orders that we wanted to do. Presently, we cannot have new builds earlier than the second half of 2024. So I don't think that it pays back to go and order additional ships. The company has achieved all its targets, and so we have a substantial cash flow being generated in the next in the past, and we hope that this will continue next year. And of course, our target is always to reward our shareholders, and our board, of course, will consider whether to reinstate a dividend. I need to mention that the dividend is always at the whole discretion of our board of directors, and we want to pay dividend when we have achieved our targets and when we have substantial surplus from operations. So if this is the case next year, I think this should be a suitable question to our board to respond, and I hope that we will be able to reward our shareholders. Our fleet employment today, I think we have always we like to mix spot and period time charters. In some cases, when the market is low, we prefer to make index-linked charters because this gives us the immediate upside. And overall, I think that our average charter duration is about a year. So I'm quite confident that the company will continue to do so. If we can develop a longer period time charters, we will do, but we will not do it at the expense of the present profitability. About spot rates, of course, during the Chinese New Year, as we come closer to the end of January, there is a material weakness in the market. I believe after that, I cannot say when exactly because there are so many parameters, but normally after the Chinese New Year, a couple of weeks after, the market becomes stronger, and we hope that this will happen again. In relation to asset values, I think that the asset values are fairly steady, and the response, and this represents an expectation in the market that no one believes that 2022 will not be a good year. So I don't think that despite the variations from now and then, I don't believe that this will change the investment profile, and the company and the valuation of the assets will continue to be quite strong for the next period. The next question is, how do you see Panamax marketing in this year with respect to coal and grain demand globally? Will there is a possibility to upside compared to last year? I think there is some information. No, Thanasis, if you can join me on the figures, because we have put some figures there about the.
Yeah, despite this seasonality, and we see that the dry spot rates have been softened, we expect that during the end of the first quarter and going forward further into 2022, we shall see the return of a cyclical strength, as demand growth is expected across all dry bulk commodities. Currently, the market will see some inefficiencies, like port congestion, and as all these inefficiencies remain an ongoing issue. But we see the results, as slow steaming and vessels being diverted to different ports, vessels taking more unloading times, and of course, COVID is still boosting the consumer spending on goods. But we believe that the rates will be affected positively, even as early as during the first quarter of 2022.
And if we go, the next question is about the economic growth of China and how this will affect iron ore and coal. We think that the data that came recently out was a GDP increase of 8.1%. China, I think, is outperforming, and this cannot be done without the substantial import of dry bulk commodities. So this is a good sign. In terms of the next question that comes here is about repurchasing the high interest preferred shares and repurchase short and leased back vessels. Yes, we always pay attention to the high cost elements of our balance sheet. The preferred shares are quite high, but they represent a smaller percentage of our capital. It could be at certain point of time in the future that we may seek to repurchase some of them, but we don't feel that this is the appropriate time. This is something that we consider a little bit later. The major issues for us last year were to deleverage the company. I want to remind you that the preferred shares are perpetual, and also to renew the fleet. I think that before that, it's more suitable for our common shareholders to be rewarded. So these are questions that will be dealt with during the next year, and of course, always subject to the ability of the market to perform well and to continue to perform well.
And also, Loukas, if I may add, we've been very consistent throughout our history since our IPO in our conservative approach towards the market and the company, and we always try to first and foremost secure the company's future competitiveness, as we've done during the 2021 by deleveraging more than 30% and placing our orders ahead of peers. So we believe that that will affect positively the future competitiveness of safe bulkers, and by the end of the first quarter of 2024, where everything will be is scheduled to be delivered, we will have increased the competitive levels of the company.
Yes, I wanted to answer also regarding the question for the sold and leased back vessels that we have. The ships that we have now left on a sale and lease back structures are not expensive. You know, we have bought back all the ships that were, you know, the pricing was higher. So now these are compared to conventional bank financing.
Yeah. And the next question is about that the shares of safe bulkers is trading in discount. Yes, we think that they are trading in discount. At presently, we don't consider a repurchase program, and we believe that the market is quite strong, and the shares will. And later on this year, the shares will reflect the actual value of the company. In relation to the fleet expansion, I think the figure for, I don't know if Thanasis can see what is the figure for the expansion for 2022. I think
it's less than 4%. It's marginally It's very close, to be zero during 2023, but for this year it's less than 4%.
Yes, but the important thing is
maybe the question is for us, for our own critics.
yes.
Plans.
Well, for us, I think we have responded in Italy, and we said that basically we think that we did our renewal and we did our new builds ordering last year, so we don't expect additional order book. The question is that in terms of the global fleet, I think we need to see what will be the response of the global fleet after 2023, because there I think there will be substantial problems in relation to the operability of certain older ships or heavy ships in relation to the in relation to the new environmental regulations. I see here one question that is whether we can give us an update on ATM. I think we have issued overall all the past periods about 72 million capital, and presently we believe that the market, the stock price is very low, so we don't want to issue additional capital at this stage. One question here that comes says about the market in Canada and Mexico the coming 12 years. We are not expert in Canada or Mexico. We are more we're a dry bulk company. Most of our products are coming from South America, from United States or Canada towards South Africa, Indonesia, Australia, towards Europe, China, India. Presently, I don't see other additional questions. So if there's any other question, we will be happy to respond.
We are actually at the end of our allotted time, so maybe Loukas, Konstantinos, and Thanasis, you can make some closing remarks.
Yes, if I can make one remark is that last year it was a year and we achieved all our major targets, which was deleveraging and fleet renewal and order book. This year, if the market is good, I think it could be a year of profitability and further. Of course, I don't want to mention other or to raise expectations about dividends, but we want to see this year and question ourselves whether at some point of time dividend is suitable. If we feel that the markets are the good markets are sustainable, and this will be seen in the next few weeks, quarters, and when we think that this is suitable.
Thank you very much. So this comes to the end of this presentation session. Loukas, Konstantinos, and Thanasis, thank you for being with us. And this presentation will also be available as a replay for those who would like to access it later on. Thank you again for being with us.
Thank you.
Thank you.
Thank you.